First, I got to share this with my husband, and I said I wanted to start this, but
Yeah, and this part, and good time to ask for this because this is the meat and potatoes here. Okay. Almost no CPA does it this way. Most CPAs are going to say, oh, well, what does a similarly situated real estate agent in Nevada get paid? That's what they're going to determine your salary. Okay. We determine your salary based on this matrix here. Okay. And it starts with net income or draws. Okay. And so if we go to your corporate tax return, okay, the way we determine net income is we start here, okay, with 97.55, but then we add in your salary. Okay. So the net income that we're going for is how much was your net profit before you got anything? Okay, before you paid yourself, how much was the net profit? And so in order to determine that, we're taking the net income, but adding in your officer comp. Okay, so that's 34,000, okay, approximately of net income before you get paid. Okay, yeah. Then the way we do it is we then apply the $34,000 to our matrix. Okay, and so 34,000 is about, I mean, it's about, right here. We would do probably around like a 50% salary allocation. I mean, the numbers are pretty modest. You see here the percentage that we would apply to salary here. Okay. And so for the 34,000, we probably would have done a 50% salary allocation. Okay. And so each of you would have split a 17 grand salary as opposed to a 25. Okay. Okay. And
I think every year I've noticed he just does a 25 every year so far. So you should have the email from the previous year, and maybe that sheds into light, because again, my husband's mortgage lending and commissions, and I'm on commissions as well. So every year it fluctuates, right? So, but 2021 was one of the best years, I would say.
Yeah, it didn't come in yet. But yeah, sometimes emails take a while to get into my inbox. Got it. But the point is your salary, which is what you pay self-employment tax on, should fluctuate as your income fluctuates. Okay, that's not what's happening here. Now, again, your CPA is zeroing out the income this way, which, I mean, they're kind of doing a roundabout way to not have to pay any self-employment tax by zeroing it out. So you show a net loss here. Technically, it's not the right way to do it. I know most CPAs would not want to do it this way.
He's not a CPA. Like I said, I think just a enrolled agent.
All right. Well, I would have had this auto expense on the S Corp return. Then the S Corp return would have had a loss, and then there would have not have been any salary anyways. Okay. All right.
Taxes are like health insurance. I don't understand. It's really deep. I don't do it every day. So I guess when you don't do it every day, it's hard to.
Well, okay. So let's talk about that because I didn't see that either. Okay. So when I'm trying to find, are you deducting health insurance?
I gave him that form and he's supposed to, but I have to go get it this year.
So when we look for your deductions, okay, this is where I'm looking. Your other deductions here. Okay. So because on the front page of your 1120S, okay, this is your income and expenses here. Here's your income. Here's your expenses. This is the net profit. Okay. And then on the K1 form, they're just splitting it between you and your husband.
So regardless, my husband's the one who has the health insurance through his work. They deduct it off of his paycheck, right? But the issue, I think, is a 1095, right? I think that's what it is. For the
So
health,
he actually pays for it from his paycheck.
correct. But I'm saying that, and then I take his and then I put it back in here showing that that's what we paid for it, right?
But it's not showing up here.
Okay,
Okay. So on your corporate tax return, okay, if you were deducting health insurance, I would expect to see somewhere either here, okay,
yeah,
or on the front page. It should be on what I just showed you, but I mean, there's no insurance line here.
corporate, okay.
Okay.
So health insurance should be deducted on the corporate
Well,
expenses.
I mean, the company's not paying for health insurance for you, right?
No.
You're ending up paying it through your husband.
Correct.
Why don't you just get your own health insurance, right? And then
Okay.
pay the premiums. Let me write down health insurance. I'll send it to you. Okay. Get your own health insurance. Pay for it from the S Corp.
Oh, got it. Okay.
Okay. And then it's going to show up in that other expense here.
Okay.
Okay. Now, similar to what your husband is doing on his return is it's getting added back into his W-2. Okay, which that's what it's also gonna be like that on your tax return as well. Okay, it's gonna get added to your W-2. Okay, so here it's gonna be an artificially high number, but then on your Schedule 1, here, okay, you're going to take it back out here.
Okay.
Okay. Okay. So the fact that this line is blank tells me you're not deducting health insurance. Okay. Now, you're generally healthy.
I'm a type 2 diabetic, but yeah,
How much
generally.
do you think how much do you think your annual out-of-pocket medical is?
You know, we've been keeping it low, so out of pocket for medication and everything like that, which I stopped taking medication, just dieting and working out. So
Right.
probably, $500. I mean, I'm not even.
Okay. Okay. So getting your own health insurance then allows you to control what type of plan you have, right? And if it's a high deductible health insurance that's HSA qualified, okay. See, I also see here, there's no HSA deduction.
And there is, because my husband, he paid $1,200 for both of us, and our deductibles are $5,000 for individual and $10,000 for family.
Okay. Here's the HSA form.
And he has an HSA account as well.
No deduction. Okay. So, and obviously I don't know, what the situation was, but this consult that you're doing, the comprehensive tax consult, it is very common that a client will tell me, well, I gave him that information. It's on my P&L, but it doesn't show up on your tax return.
Okay.
Okay. So you're saying you do have an HSA account.
Yes.
And in 2022, you did make contributions to the HSA account.
I believe so. Yeah, I think it started, we didn't do 2021, but I think we started in 2022. And then now, yes, this is 2023 that we're going to file. So yes, these last 2 years.
And if it's a high deductible, if you had a high deductible HSA qualified plan, then you should get a deduction for the contributions up to the limit, which in 2023 was $7,300. Okay.
Well, I mean, I see those numbers there, but you're saying he shows it, right? There's 73.
No, this is a 0.
Oh.
This is a 0, okay? And on the schedule where it would be taken out, there's nothing. This is an adjustment. Schedule 1 is where you would adjust your income for this.
Okay.
And for both the HSA and the health insurance, and there's nothing here.
Okay.
which is, you know, and I don't expect you to be an enrolled agent or a CPA, but the sad commentary is that you can't expect the person that you're hiring to do your taxes to do these things for you.
No, I almost feel like I have to go watch some more videos to actually understand what these
Exactly.
documentation
And
is.
so that's kind of what I'm doing is I'm showing you where to look for these things.
Mhm. Yeah.
Okay. Right. So health insurance, that was a big one. Your meals, I mean, as real estate agents,
He's been doing 50%, and I was listening to that, and some you could do 100%
well, that was back in 2022.
Yeah.
Okay, the meals adjusted starting in 2023. Okay, but
Yeah.
for you guys, I mean, you guys are both. I mean, you're doing flips. You are, you know, you're both in the real estate industry. I mean, I would expect that you're both shareholders. You're both directors. You know, every time you go out to eat, you're going to be talking about something relating to your rental or your fix and flip or your commissions or deals you got and be writing off a meal.
Yeah, I think it should be everything.
I mean, this is pretty low for
I don't even know, and I feel like some years, that's why, yes, I have to fire him. I go, some years, I'm like, hello, even $4,000, but now that I'm looking at this, I gave him more than $1,000 for meals. I think it was like 10, 15. So I feel like he's almost pulling numbers from, I don't know where, like the previous year's tax. I've never had meals at $587. So
yeah.
I don't even know what that
This
is.
stands
was
out
like,
for a realtor. For a realtor, this kind of stands out.
yeah.
Okay. All right. Now the travel is okay. You know, I mean, the income here is modest, at least for this tax return. I mean, only 9,700 in net income, and if we put in the auto, the 23,000 auto, this would have been at a loss. Okay, so we can't get too aggressive here, you know. But like Mark, you know, if you have a high income year, like Mark Kohler, he puts his 4 kids on payroll, he puts his family members on payroll, and then he writes off trips that they go on vacation because they spent some time doing a board meeting.
I've been listening enough of his videos, and so yeah, when I start to research, I research a lot, but I've listened how you can put your kids and pay them, and you have the $13,000 for, you know, they don't have to file taxes on the kids, so pay them, take the money back, like just a lot of little different tips.
Right. Right.
Pay your kids.
Unfortunately, like I said, you got to be the captain of your ship. You got to make sure your CPA is doing this. And if they're not willing to do this, because for some of these, the CPAs don't want to do this, like especially for home office, they don't want to do it. They're afraid of it.
Someone did tell me, I spoke to another role agent. He goes, I work from home. My husband works from home. We do own our home, but we literally have 2 offices. He's upstairs, I'm downstairs. I'm like, why are you not taking the utilities off of it? So I told him last year, I go, you need to add the utilities in it, you know, because we are here working full time.
Plus, you have mortgage interest.
Yeah, he only did like the square footage of my home for my, you know, the location, but he wasn't doing the utilities.
Let's look. Okay, I see something here for utility, but this is all carry forward because you had a loss on your Schedule C. Okay, so he is putting the utilities, but because this is on a Schedule C.
He did it because I told him that year. Okay. But the previous years is not there.
Okay. But you're not really getting the benefit of this because it's on your personal tax return. Again, it should be on your all of these expenses here, the whole everything that's here on the Schedule C should be on your corporate tax return.
Okay.
The fact that they're putting on the 25,000 shouldn't be here. It should be on a W-2. And these expenses shouldn't be here. It should be on your corporate tax return. You know? So again, I don't know that the IRS would necessarily audit this because you can amend it and make it look correct. But this is not the way that we wouldn't have done it this way. Okay, you should have no Schedule C.
I should have no Schedule C. Okay. Yeah.
Okay, all of this should be reported on your 1120S.
Okay.
Okay, and then on the 1120S, you want to minimize your salary as low as you can get it using this matrix as a starting point.
How many times can you amend something? Because I think he's gone back to amend the 2021, but he amended, obviously, doing this personal. And if we're talking about the strategy and putting it on the corporate, I suppose, because I haven't amended my corporate. I amended my personal.
Well, I mean, you can amend as many times as you want, but I mean, every time you do so, you're raising a red flag.
Mm-hmm. But I'm still paying every year for
like I said, I mean, it probably is I mean, even if they amended it, I mean, it looks better, but I don't know that it would move the needle that much because, instead of having a huge deduction here, it would show up on your corporate tax return. So it's like you're just trading where the expenses are.
I got you. Well, because I'm still doing like a payment plan for my personal taxes right now, 1,000 a month. So I think I'm probably down to 10. I got to go look again.
Yeah.
Haven't filed 2023 yet, so maybe.
Well, there should be no Schedule C. Again, I don't know your 2023. I don't have it in front of me, but you shouldn't have a Schedule C on your 2023. Now, let me ask you something. The 25 grand that you're showing as salary, do you ever get a W-2 for that?
No, I don't. That was the other thing. I don't have a W-2. I didn't do anything with that.
The CPA, I would imagine on your 2021, he's doing the same thing. He or she's doing the same thing.
Yes, it's been like that every year.
Putting the officer comp on a Schedule C, and then, which is not the right way to do it. And then by putting it on a Schedule C, they're then saying, well, you're going to pay self-employment tax on this, but you're not paying self-employment tax on this because then you're taking this expense. So this is an audit risk right here because the 25 grand that you're showing as a W-2, you should be paying self-employment tax on it. And you're not because they're zeroing it out with this high auto expense. And so this, I mean, the IRS could definitely disallow this.
Yeah.
So the 25 grand should be a W-2. There shouldn't be a Schedule C, and it would be added to the 14 grand here. Okay. And then you would pay self-employment tax on that 25 grand. But again, like I said earlier, the 25 grand is already too high based on the matrix. Okay. Remember, we said it should have been maybe closer to 15 or 17 grand.
Okay.
Okay. So again, the way we determine salary, it fluctuates based on your net income.
So does Mark have YouTube videos on how to read the tax return and stuff too? Because I've just been listening to, what to take for deductions and stuff. Does he go into that?
He does not have it for just a regular YouTube. That's where we talk.
Okay.
Okay. And I'm
trying to see how do I understand this.
I can send you the stuff and it's recorded.
Oh, got you. Okay.
Okay. So, officer comp, this is where we want to look. Okay. We want this to be as small as possible without triggering an audit. Okay. And this has to show up as a W-2 on your tax return. If it doesn't, you're creating an audit risk. Got
it. So yes, he's doing all this and he didn't show a W-2. So he just
correct.
Okay.
Correct. I mean, sometimes we do it if a CPA didn't do it the first year, we might do it the first year, but we don't make a habit of it.
So do I issue myself a W-2 and then I give,
I mean, it should be your CPA that does that.
Okay.
I mean, with an S corp, the IRS expects if you have positive income, the IRS expects something here on the officer comp line. Okay, they expect you to take reasonable salary in an S corp. Okay, but then this should be a W-2. It should not be showing up on a Schedule C. Okay. And then, like I said, the other place that we're looking, if it's not here on this deduction, line 7 through 21. Okay, and I also highlighted this rent. I'm not sure what this is. This rent for 201. But anyways, I mean, you could check that. The other place that we look at.
Go
ahead.
The only thing I can think of is my husband has a branch, but I think he pays it out his his branch's P&L, but it is
Okay.
$600.
Well, I mean, this it's a nominal amount, but then the other deduction line, this is where you take all the other deductions that there's not a line for on the front page.
Uh-huh.
Okay. And so this 35 grand, so we go to the separate statement here to get to the 35 grand.
Yeah.
This is where all the other expenses are. So here we're going to be looking at your travel. We're going to be looking at your meals. We're going to be looking at your auto. You know, I mean, you have parking fees and tolls, but no auto. That's showing up on your Schedule C.
So yeah, I have 2 paid off cars, and so he should do, I guess, what, a standard the deduction for the auto? I mean, yes,
Well, it looks like you're doing, it looks like you're doing mileage.
Okay, mileage.
Okay. It looks like you're deducting mileage because I saw on your personal tax return some mileage calculations. And
Yeah, because I haven't, I used to keep record on an app, and I don't. Yeah, so it's just like, you know, if that's something I have to do again to keep mileage, but I use my car for personal and for work.
yeah. Well, you got a ton of business miles, so probably the mileage method makes sense for you, and it's
Yeah.
easy as long as you are keeping track of this. Okay, so it's good. I mean, we expect realtors to have a lot of miles. Okay, so it's good, but it's just not showing up in the right place. Okay, trying to take a mileage deduction to lower what should have been a salary on the Schedule C, I mean, the IRS could disallow that because this is supposed to be a W-2.
Got it.
Okay. We talked about the health insurance. Okay. I mean, to see if you were deducting health insurance, we go again to the other expense line to see if there's a health insurance line here. There isn't here. Okay. And then we also see, well, what does it show up on the personal tax return under the health insurance deduction? And it doesn't on Schedule 1. No health insurance, no HSA. Okay. Those are the main things that I saw. Okay. So salary, properly writing off home office, health insurance, meals, and then an auto.
Okay. Yeah, that's good. I'm glad.
Okay. All right. So that's what I saw on the tax returns. What other questions do you have on the structure? Because it looks like you have some questions on the structure. I started building this. In 2022, it looks like, well, it doesn't show up on your 2022. It looks like you just started this flipping stuff.
Yes, that's I've only purchased the end of October 2023, and then this year. As you can see, it always is hard when you first start, but then once you get in a role, I don't see, you know, I see myself, I have to hold back right now because I'm moving too fast. So
too much on your plate.
Yeah. I mean, it's easy. I'm a REO listing agent, so I know how to
You
buy
get good deals.
Oh yeah, these are all, you know, that property on Elm Drive, I just listed last Thursday. I've got offers and I bought it for half the price. So people don't know about it because
these are these off market?
No, they go on the auction website. Just that a lot of people don't know
Oh,
about.
right. But they're not showing up on the MLS. That's why you're getting the good
It
deal.
depends. No, it depends on what it is. Like I said, you have to kind of know what you're doing. And I have a YouTube video on how to do this too. But
awesome.
REOs are been gone for so long, people forgot what they are.
About 10 years. Yeah, it's been about 10 years since I've had people.
These are FHA loans, and so they put it on these auction sites, but they don't go on the MLS. You are right, but they're on Zillow. So if you do search, it always shows up on Zillow.
Yeah.
So yeah,
but there's no commissions going to agents.
No. I'm strictly buying as an investor. And here's my other question, which was having partners and what do I do with an LLC? I'm trying not to file too many tax returns. So that's probably where I need help in.
Well, is this the
structured
only
this.
one with the partners?
No, they all do because I live here and I'm buying on the, you know, I'm buying the Midwest. I'm not there. I haven't seen
Oh,
any of
yeah,
these.
but the partners are the boots on the ground.
Yes.
Okay.
One is a realtor in Warren, Michigan. He's a realtor too. We all have LLCs because we belong to this investment group that, you know, is showing us how to partner up with people to move faster. But I just do not want to do so. Like, can I get a series LLC? How do I do the subsidiaries? You know, and I want to file tax.
Okay. Well, I mean, how familiar are you with the trifecta?
I've listened to probably
Okay.
30
Okay.
hours
So
now.
fix and flips are going to be here.
Okay.
Okay. Um, and like, how many of these do you think, and you're looking for more, right?
Oh yeah. Well, I'm looking for buy and hold. These fix and flips were just to start my capital, but I figured out how to get money now, and the hard money lenders are doing the purchase, and then I turn around, I do a DSCR loan to get a 30-year, and then
That
I'm
what you
buying.
did with the Evansville?
That's what I'm going to be doing. Yes, that
Okay.
is going to be a midterm rental to traveling nurses. My partner is a traveling nurse who
Okay.
also has an LLC. Do we buy it and hold title as two LLCs? You know, do we create an LLC? I really don't think I
That's
want
what
to.
you're going to do for Evansville?
I don't know what I'm going to do. I'm talking to you. That's why.
Okay. All
Right
right.
now it's currently being purchased under Satori Ventures. That's the contract name. I have it under.
For Evansville.
Correct.
Okay. One of the things that the reason why this line down the middle exists because we never crossed the line.
Uh-huh.
Okay. So Sartori Ventures is either your flipping entity or it's a hold entity, and it's not both. Okay.
Okay.
All right.
I created Satori Ventures as a holding company, not necessarily for the buy and hold. And I was going to have all the other smaller ones. And, you know, one LLC was going to be for fix and flip. One was going to be for midterm rentals, right? One could be for Section 8. And so.
Okay. But hold on. The fix and flips and the rentals, those are two different activities taxed differently.
Okay.
Okay. The fix and flips can either be short-term capital gains or ordinary income, just like your realtor income.
Okay.
Okay. You're familiar with dealer status?
I've heard of it.
Okay. It's on my list of stuff to send you.
Okay.
Normally, when you flip properties, like if I buy 100 shares of Apple stock, sell it 6 months later for a gain, that's a short-term capital gain. Okay. Similarly, if I buy a piece of property and I sell it 6 months later, short-term capital gains.
Yes.
Okay. But if I'm buying and selling properties left and right, like I have so many transactions, at some point, the IRS is going to look at that and says, you know, this doesn't look like some side investment that you're doing. This looks like you're in the business of flipping properties.
Got you.
And if, in other words, if you're considered a dealer, like these properties is not just one or two investments, this looks like inventory.
Yes.
Then that income is no longer going to be capital gains. It's going to be ordinary income.
Okay.
And in my article, it talks about some of the factors. Generally, go ahead.
Can I do a 1031 or I'm not there for the time frame?
Not if you're a dealer.
Yeah.
Okay. All right. Because a 1031, the property has to be held for investment, which means you have to rent it out. And typically, I'm going to say at least a year on your tax return to show that you're renting it out.
12 months. Yeah.
Okay.
Yeah, the goal is to buy and hold, is not to fix and flip. And I only did these first fix and flip because I really don't, I'm just starting. I have no clue. I'm still finding the deals. It turned out I flipped it because a lot of these lenders don't lend to people like me who have very few experiences.
Right. Right. They want a high W-2. Right. So how many of these flips do you think you're going to sell in this year? You have 3 of them sitting here, right?
I'm selling. I may hold Warren because it wasn't selling, so I may turn that into a rental right now, even though it's listed. So I think this year maybe 3. You know, so far I'm going to keep I'm only keeping that Evansville one and maybe that Warren, Michigan, because it's so slim on profit that I said it's probably best to just keep it and make our money back. So I may refinance it and then rent it out. So flip two and keep the other. And then guess what? There's future ones, which I will try to do as a buy and hold. So I don't know what's a good number to not be considered a dealer this year. You know what I mean?
Well, our general rule of thumb, and again, you're going to see my article. It doesn't say that in my article, but as general rule of thumb, we typically say 3 or more.
3 or more, okay.
Okay. If you're doing 3 or more in a year, we think the IRS is going to likely consider you a dealer. And if you're making a lot of money, it would be ordinary income, sub to self-employment tax, in which case we would want to run it through Soleto Enterprises.
Got it.
To save on self-employment tax. Okay.
What's a lot of money? Is there a percentage? Because obviously it should be a percentage. Some of these, I'm buying low, but I'm selling for 40 to 50%, but then there's rehab costs and all that. So, trying to think, it should probably be
what do you think your net profit's going to be? Like, for example, again, I'm not going to hold you to it, but if you flip these 2 properties, what do you think your net profit is going to be after all the rehab? What's your profit?
Well, here's the issue too, is I have 2 other partners, so we all split. It was like 5 or 6 grand. I mean,
Yeah.
That Warren,
Okay.
Michigan, it's costing me 39,000. I purchased it for 60 grand, and then now we have to pay, all the costs. So I think we make 30 grand divided by 3 people.
Right.
It ends up not being very much.
Okay. Okay. So, I mean,
so it becomes a volume
this
deal.
really depends on your CPA, okay? Because the dealer status it's a factor, it's a bunch of factors.
Okay.
The frequency is the number one thing that the IRS looks at.
Okay.
Okay. But for example, in my article, I list all the factors that they the frequency, the duration of ownership, the type of improvements. Are you just doing a cosmetic improvement, or are you buying raw land, subdividing it, building a bunch of track houses and then selling? Are you a developer? Okay. So I don't want to speak for whoever's going to be signing your tax return. Okay. But probably if you only had 2, I would probably consider you not a dealer and just report it as short-term capital gains.
Okay.
And you're not planning on being professional flippers, right?
No.
You really want to buy and hold.
That was the other thing, is this is me fueling my retirement, since I have no retirement income. I didn't save for retirement. That might be another thing. The Roth IRA is what I'm missing. I have not put away. I lost about 10 properties during 2005 to 2008. So all those properties went away. And now I'm redoing it again and trying to fund my retirement.
Right. And that's one way. That's one way. I love it. Okay. You also can do a solo 401k.
Okay.
Okay. Now, I agree that if because you're a real estate professional, okay, so potentially there could be losses here on the right side that you can use to offset income over here. You know what I'm talking about? Real estate professional. Okay.
Well, I understand the 750 hours. I have it. I've been doing this. So most people want to be where I am with the real estate professional. So I already have
the
that.
material. Your problem is the material participation. Okay. Because you don't live in Ohio or Michigan or whatever. Are you going to be able to meet the material participation test that would unlock the losses here to then offset other income? Okay. But I agree. Buying rental properties over here, that's part of your retirement. Okay. But you should probably also consider doing a solo 401k and investing that in some other stuff to diversify. Okay. So solo 401k, you can have Roth accounts there. Like for me, I buy rentals too, because my wife is a realtor too. So we buy rentals on the right side to take advantage of the real estate professional. But then here in my 401k, I'm going to invest in crypto. I'm going to invest in some stocks. I'm going to do alternative assets. I'm going to buy, Grant Cardone funds, maybe
So
do some.
down the road, maybe buy some businesses or something, but that's, I just need to focus on one thing right now. And so would businesses be on the, what side would that be on? On the right side?
Businesses generally are going to create ordinary income.
Okay,
So they're going to be here. And if you could own it through a retirement account, but then you implicate a tax here called UBIT.
okay.
Okay. So if you were going to self-direct your retirement account, that's probably a separate conversation because you're not there yet. Okay. But there's a bunch of rules here. But if you're investing in businesses, it's going to depend on your level of involvement.
Hi.
Um,
That's all you need to tell me. I just want to know it was on the left side. That's it. That's
Yeah.
another day, in the future.
Yeah. I mean, right now, the purpose of this call is just to kind of talk about now,
Okay,
and then once you get to some of these other things that you want to accomplish, we can always come back and adjust your situation. Okay.
so
But
how do I own, the different properties? Some are, going to be a midterm rental and long-term. And in each state, but I would like to file the taxes for Soleto Enterprises, which is for the S Corp. Now, how do I file taxes for these other properties that I own them in under LLC? And you're saying I
well,
got
let's say this. Okay. If you were doing a partnership, okay, then I want the LLC to own the property.
okay,
Like in this Evansville, I would want an Indiana LLC owning the property.
and I can own multiple property addresses, and I name it, probably the state. I guess now that I'm thinking about it, just let's say it's for simplification. Indiana LLC. I own all the properties in Indiana under that LLC.
But do you have the same partner for all the properties you have in
No,
Indiana?
I don't.
Okay.
This is my
That's
conundrum.
where it's going to get a little bit complicated as far as all the tax reporting, because if you had the same partner for all the properties, then we can probably consolidate them. But if you have different property,
Partners, different. I don't think I plan to do that. I just wanted to do this for experience, but I may not go that route. I don't need a partner for every property. That's just a little too much for me.
right? Okay. But if you did, this is the way it would look. For example, if you own
Okay.
if you own 33%, we want a LLC, your share is owned ultimately by your trust for estate planning. Okay.
Yeah, I'm aware of that one.
Right now, I don't know that you really need Sartori Ventures. I mean, we do set up Wyoming LLCs for some anonymity or for, at least on paper, more asset protection.
Well, can I tell you why I still want to keep that, that's Satori, never mind. Soleto is still staying there because I'm looking to try to acquire business credit, and Soleto Enterprises has been
Yeah,
around.
we could domesticate this to Nevada and you keep the same EIN, keep the same corporate credit. That's the
Yeah.
domestication. But Sartori, do you have any reason why you would want to keep that you can express?
No, it was just something I had started to go buy properties with. So that's why it started. It was supposed to be the holding company and then a multitude of other smaller LLCs underneath it.
Right. Yeah. I mean, if we were going to set up a Wyoming company, it would be a holding company here and it would own your interest in other LLCs,
Yeah.
like the Indiana LLC
That's
would
why I
be
told
owned by
you
the
I
holding
kind of-
company. Your
I kind of messed
Ohio.
up.
Go ahead.
I kind of messed up because that was supposed to be the holding, and then I was supposed to create the smaller one. So do I just turn Satori into one of the smaller ones and then create another holding company above it? That's my question to you.
Either or.
Okay.
Either or. Now, why do you want the Wyoming holding company here?
I don't know if I necessarily do or not.
Okay.
I was
There's two
told
reasons to
keep
have this.
Wyoming.
I'll send you the stuff on Wyoming. There's two reasons to have a Wyoming holding company. First, Wyoming is pretty good with anonymity. Okay. So
That's why I have.
sometimes,
That's why I have.
because Wyoming doesn't require you to disclose who's running the company. Okay. So sometimes we use that to hide who actually is running the company. Okay. The
Do you
other
think
reason,
Wyoming is better than Nevada? I mean, I live in Nevada, but
no, Nevada's not good.
okay.
Okay. They used to be good, not anymore. If you look anybody up in Nevada, their information's all over the place.
Yeah. Okay.
Okay. I don't know if you've checked the Nevada Secretary of State recently, but no, Wyoming, you know, it doesn't, if you do it right, it doesn't disclose who runs the company. Okay, so anonymity is one reason. The other reason is for more what's called charging order protection. Okay, Wyoming has pretty good, probably the best asset protection laws as far as charging order. Okay.
I listened to that Mark's talking about
Right.
that. So I understand.
We call it a COPE entity, charging order protection entity. Okay. The issue with that is that I can only guarantee that you'll get the benefit of that strong Wyoming charging order law if you're sued in Wyoming. If you're sued in Nevada and you're in a Nevada court, I can't guarantee that the Nevada judge is going to apply Wyoming law. You know, I'd have to see what their rules are when a out-of-state LLC is in a Nevada courthouse. Okay, so that's why I don't often recommend the Wyoming COPE unless you have a bunch of rentals. Okay, so but if you want to keep it and build it, I mean, I don't have a problem with that. But I'm going to be very clear that, you know, it's not guaranteed that you're going to get the benefit of the Wyoming strong laws unless you actually were sued in Wyoming, which is
okay. I got you. I don't think I plan to at this point buy any properties in Wyoming.
right. So our starting point would be set up the Indiana LLC for the Indiana rental, the Ohio LLC for the Ohio rental, whatever. If you have different partners, you're probably going to have multiple LLCs, you know, one with each of the partners in it.
So when I file, I mean, now, you know, you're dealing with that FinCEN. So when I file taxes at the end of the year, how many am I filing?
Like here, so I'm putting here the tax forms.
Years. Okay.
Okay. So here, there'll be a separate 1065. Here would be a separate 1065. Here would be 1120S. This would be a single member LLC owned by your trust, so no tax return.
Is this like a one document attached to the one you're filing?
I'm sorry?
Is it like one document that you file along with your tax return?
Is what one document?
That 1065. You're like, you're saying.
No, it's a separate tax return.
It is?
It's like your 1120S.
So it's another fee. That's why I said I can see it getting expensive. I'm not at the point.
Yeah, exactly. So, I mean, like in these states, Ohio and Indiana, you may have different partners. Do you have a situation where you may have the same partners for different properties?
Yeah, so far I have two, which is the Warren and the Bryan, Ohio. Can we just use the joint venture agreement and then I own it under my LLC? I mean, what is your best route at the point where I don't have to do all these multiple tax filings? What do I do?
But the deal is that you're sharing the profits with the partner. When you're sharing profits with the partner, the IRS says that's a partnership, 1065. So even with the JV, it would be a 1065.
Okay.
Okay. Now, what I'm saying is, if you have the same partners in multiple properties, maybe we'll have we use one LLC for the properties where you have the same partners, right? The problem is then becomes asset protection. If you have multiple eggs in this basket, something happens in one, they can get at the equity in the other. You with me?
Yeah.
Okay.
I almost feel like the next in the future is get rid of your partner. So I don't buy things.
If you don't need it, I mean, just starting off, to do some of these deals and to have boots on the ground, I can understand why you would need that. But I mean, in any given state, how many different partners are you going to be working with?
I mean, who knows? I mean, like I said, I'm just gonna have to figure out, get good property management,
Yes.
and that's it, and be done with the partners.
Yeah. Yeah.
Okay, I saw you going to the series, and then so each state, or not each state, if I am staying in Indiana, I mean, I'm almost jumping into Kentucky too. They're so close, but I'm aiming for landlord-friendly states. That's kind of where I'm going right now, and that's
Yeah.
I'm making my decision based on.
So you're familiar with the series. I put the series structure here just to show you it exists.
Okay.
You know, both Indiana and Ohio are series LLC states. So
Okay.
we might do an Indiana LLC, for example, that is then foreign in Ohio. Kentucky is not a series LLC state at this time, so we would have to structure that separately.
I
Okay,
know Nevada is because I see these
Nevada
investors
is
buying it
correct.
here in Nevada in a series LLC.
Okay,
Is that the same word as subsidiary?
say again.
Is series the same word as, because I hear people saying subsidiary, like you have one LLC and then you have subsidiary LLC. Is that the same word as, or in,
It's kind of, but not really.
okay.
This is a subsidiary. Okay, so like you have a parent company that owns another company. Okay,
Mhm.
this would be the subsidiary, this would be the parent. Okay. The relationship in a series is kind of similar to that, where you have a master and you have a series. It's not technically a subsidiary.
Yeah, got it.
And the reason why is because all of these are separated asset protection wise.
Okay.
Okay. Whereas this is not necessarily true. If I had a huge judgment against the parent company here, I could potentially get at the income and assets of the subsidiary,
Okay. I
which
got it.
where that does not apply in this structure.
Okay. But I understand what you're trying to say right now because it was a Wyoming and you said
This
you're okay if I
Wyoming,
kept it.
if you wanted the extra COPE asset protection, then it would be here. And then this LLC owns all your interest in other LLCs that are actually in the states where you're investing.
Yes. Okay.
That's what if you wanted to keep Sartori.
Mhm.
Okay. But then, you have to decide how complex do you want your life to be with all these different LLCs that you have to maintain.
But if I don't keep that as a holding, I just have a bunch of other LLCs for the state I own the property in.
Yep. That would be our starting point. Yes. Okay. This would be our starting point. Okay.
Okay.
An Indiana LLC owning the Indiana property, the Ohio LLC owning the Ohio property. If it's a long-term hold, maybe you do a series, but even the series is not going to avoid these separate tax returns if you have different partners,
Okay.
you know. So frankly, I think that Evansville is going to be a buy and hold. So you're probably going to want an LLC for that
Yeah.
in Indiana.
Okay.
Okay. And then for the other properties that you're going to get in the future, I mean, let's just kind of do a wait and see approach. Okay. I mean, right now you only have one potential buy and hold right now. Right.
Yeah.
Okay. So we can set that up because it's going to be a buy and hold. Okay. But then as you further develop your long-term holds, we can recommend an appropriate structure at that point. The variable is the fact that you have partners and whether you're in a series or non-series state. If you didn't have partners, we would set up one series LLC for all your Ohio and Indiana and Nevada properties.
Okay. Well, I guess that's the goal. I will not partner in the future. But if I'm currently going to close, it's going to be Satori Ventures, then I can just change title once I create the other LLC in that state and just deed it over to the Indiana LLC and get out of the Satori Ventures, right?
Yes.
Okay.
Yes. But you're talking about the flips.
No, the Evansville. right now
Oh.
it's being purchased under the title of Satori Ventures, but that's a Wyoming LLC. So if I create this new LLC with this partner in Evansville, then we will change title to the new LLC.
Because it can be a long-term hold. And you
Yes.
own other properties in Satori right now, right? Or you will?
I will own the one in Akron, Ohio, but that is a flip. So there's some that are going away. So I'll only
Okay.
own
And
for
that's
short
why,
term.
and that's why I would want to set up a separate LLC for the long-term hold, because you got other stuff going on here,
Mhm.
you know? So that's why I wouldn't want you to use Sartori Ventures as the long-term entity that holds the Evansville.
Yeah, because right now I have bank accounts for it, right? I already set up Satori Ventures LLC. I don't know if I would necessarily take if you were in my situation, which is I have a bank account. It's almost this year is 1 year old, right? That this Wyoming has a bank account and it's 1 year old, but it's in Wyoming. So I initially was going to use that as the holding company and own everything else underneath it.
Which you could,
Okay.
if you think it's worth it.
But I don't know about own properties there, that's for sure. I just,
I mean, I don't know. If I were you, I wouldn't, it would be an extra complication in my life, really.
okay.
You know, now, again, like I said, if you have like 10 properties, well, maybe now it's starting to make more sense.
When you say I should, so do I dissolve it? Because I don't want to file a tax return for that one. Oh, that's the thing.
Sartori Ventures, it's not a single member LLC.
No, it's my husband and I. So he's a 50% owner.
Right. But you live in a community property state, so it could have been a single member LLC.
Got it.
What's the EIN number say? The EIN letter.
Uh-huh. I don't remember. I have to go look at it.
Okay. Does it say you have to do a separate 1065 the way it was filed?
Oh, okay. So it says it on there?
Yeah. In the middle of the EIN acceptance letter, if it was filed as a partnership, it's going to say every year you must file this tax form 1065.
Got it. Got it. Okay.
Okay. If
Okay.
it's a single member LLC, on the EIN letter on the addressee, it would say, for example, Jennifer Soletto, comma, sole MBR.
Okay.
And then you wouldn't see anything saying that you have to do a 1065.
Okay.
Okay. All right.
Okay. So here's what I would also need. So now maybe a recommendation of someone who does taxes that are familiar with
With what we
on the
talked
same
about,
page. Yeah, same page as what you guys are.
do you know about the Tax Advisor Network?
I hit it. I heard about it being mentioned on
Mark Kohler's website
yeah.
here. These
Okay.
are tax advisors that Mark is personally training.
Yeah. I know
Okay.
he's releasing a bunch of new people, but I've been listening to 2 years old for some reason. That's what's popping up.
Yeah, he just started this in last year.
Okay.
Okay, so you're not going to hear any reference to it back prior to 2023, but these this is who we're sending people to if they want tax prep.
Got it.
Okay.
Fine.
So you're probably going to want someone who has some familiarity with real estate.
Mhm.
And like, I don't know how many we have in Nevada, if that even matters. But this is where you would look.
Okay, got it. Did you ever get my 2023 tax return? Not the, I mean, 2021. I don't know, we ran out of time
I did.
probably, so
Yes, I did.
it's just a little
Hey,
glance.
hold on. Let me scan real quick since I got you here.
Okay. Be right back. Hold on. Oh, okay.
Okay. Yeah, I mean, it's pretty much the same thing that I saw in the 2020 two. Okay. So on the S Corp tax return, the net income is, 27 grand. Okay. So this salary is way too high for a 27 grand net income. Okay. Stop me if you have questions. I'm gonna just rattle on.
Okay.
Okay. Then again, like I said, we're looking at what are the other expenses here. Okay. So we're going to go down to the other expense line. Okay. Look, meals are much better on this one. Okay. Travel is about the same. Again, no health insurance. No home office, at least here. Okay. So same thing. Hold on. Okay, here's your auto. I'm sorry. Okay, now auto shows up here on your 1120S. Wonder why it didn't show up on
Did you
your
scroll? Are you sure it didn't show up on the other one?
for 2020. You're talking about 2021?
Yeah, no, 22.
2022, it showed up on your Schedule C.
Okay.
Okay. Now, this I'm not understanding. Like, there's a $12,000 auto expense on your 2021 1120S, but then there's also a 24 grand auto expense on your Schedule C for 2021. I'm not sure about that. Okay, is this double dipping? I don't know. Okay, in 2022, there was no auto expense on 1120S, but it was all put on your Schedule C.
Okay.
Okay. But they're doing the same thing where they're taking the $25,000 W-2 and putting it on Schedule C and showing it a loss. There's hobby loss rules that say if you continue to show losses here, the IRS can come back and disallow the losses. I'm already seeing 2 years of losses on a Schedule C. If your 2023 shows another year of losses, the IRS could look into that.
Okay.
That's why we don't want this on a Schedule C.
Okay.
Okay. Same thing. No HSA deduction. No health insurance deduction. Okay. So it's similar. It's similar. I mean, your husband had a huge W-2 from the mortgage company. That's the only thing that's really different. Everything else, and the auto being reported on a little differently, but it seems like same thing with the CPA.
Mhm.
So, yeah, I don't like the Schedule C. You should not have a Schedule C on your tax return. That's the whole reason why you have an S Corp.
Got it. Yeah, I guess that makes sense. Yeah, because the Schedule C is for personal, right? And so he's just sticking
But the
everything.
reason why you have an S Corp is so that all your business stuff is reported here.
Mhm.
I mean, I don't know why the CPA is not doing a W-2. Instead, they're putting year after year after year, they're putting what should be a W-2 on a Schedule C. Again, that's not the way it should be done, and you're creating audit risk, because you're not supposed to be taking deductions off of W-2. You're showing losses year after year after year on a Schedule C, which could be disallowed after a while. I'm gonna put the hobby loss stuff that we have on this. It's just not the way it should be done. Anyways. All right. Anything else? I'm gonna put together this, put some action items here, send it over to you.
Okay.
If you want to do a domestication or set up an LLC or do your trust when it's right, just come back and let me know.
Yes, the asset protection, if I schedule for that, because the only reason I'm pushing out to May was I think he gives his $300.
Well, the trust doesn't give you asset protection.
No, the trust, was it the revocable trust?
Yeah, I'm trying to get back to
Owns
it.
my LLCs. And then we don't have one, and so we own our primary residence in our name.
Hold on. Okay, here we go. Yeah, the primary residence would be owned by your trust. Okay, but that's not going to give you any asset protection.
The LLCs do. No,
The
I understand.
LLCs do, correct.
Correct. So I have a trust. It's gonna own, and I guess is who's my beneficiary in the trust?
It's going to be, who do you want to have this, everything you're building here, when
Yeah.
you die, when you and your husband die, who do you want to have it? That's going to be your beneficiary.
Okay.
This is for estate planning.
Mhm.
Okay, the asset protection is at the LLC and S Corp level.
Correct. But and then that revocable living trust owns the LLCs. And
Correct. For estate
they're for
planning.
privacy. And then, okay.
A little bit. I mean, not much privacy here.
No. So if I make that appointment, if I already am talking to you, do I come back to you?
You can, yeah. Just let them
Okay.
know when you set up the appointment that I'm working with Lee. You know, when the special comes, probably going to be about another month and a half when the special comes. Yeah, just say I'm working with Lee. If you don't say anything, they'll probably schedule you with me anyways because we have an existing relationship. So
Yeah. Okay. All right. Well,
anything else?
no, I mean,
Okay. All right. Well, look out for my email. And then if you have any questions, if you want us to do any of the setups or domestications or what have you, follow back up. And then again, I got a pretty long list of stuff to send to you. Okay.
no.
I just want you to have it.
Domestication was just for you guys to set up, and then there's the state's filing fee, right? So that goes on top of it, which I know there's like another $1,000 or something in Nevada. But I just do a domestication of my LLC because the S Corp is just a box they check for the filing when you do but I'm still doing it as an LLC because that's what Soletto Enterprises.
Soletto Enterprises?
Yeah. It's an LLC
it's
with a selection of a S Corp.
It's an LLC taxed as an S Corp?
Even I do have articles.
No, it's an Inc. It's an Inc.
Okay.
It's an Inc. So you're
I
domestic.
know it does say Inc on there, but I was like, I guess I started off as an Inc. And does that make sense too? Should I be bringing it over as an Inc. or do it as?
You should be. It should be brought in as it's in California. You said.
Yeah, I'm trying to get out of. I've been out of California.
It should be an Inc. Let me just check. It is an Inc.
I don't even know why I have it as an Inc. But
Well, it makes sense. I mean, for a business, yeah. For a business, yeah. You file articles of incorporation, so it's an Inc.
Well, what should it be when I bring it to Nevada?
Should be an Inc.
Okay.
You're domesticating a corporation from California to Nevada.
Right. So your company does the domestication and the fees $785 plus all the Nevada filing fees, whatever that is, right?
Correct.
Okay. It's an Inc. Okay, that's it. I guess.
Okay. All right. Well, just let me know. I'm going to send you an email with all the stuff and then just follow up if I can help with any of this.
Okay, and I'll get this recording that we
Okay. Yes, I'll attach a link to the recording.
Great. Thank you.
All right. Thanks, Jennifer. Have a good one.